Okay, so again, thank you very much, ladies and gentlemen. Hope everyone can see this. So this is a short course in what I call rational investing. And I want to remind people that nothing in this presentation is advice or recommendation, for information only. All investing, of course, involves risks, and readers should seek the advice of a registered financial or investment advisor or conduct their own thorough due diligence before making any investment. So basically, my key message to people today is don't buy individual stocks. As the cartoon shows, investors are hanging on to the bull market with one hand these days, really not knowing what's coming. And if we look at the history of things, the chances of beating the market are almost zero. In fact, even legendary investors such as Warren Buffett haven't been able to beat the market over even the last 10 years. So it really raises the question, why bother doing it at all? However, if you are interested in knowing about how you select good companies, and this is well worth knowing, even if you are going to buy ETFs or mutual funds, still understanding how great companies are selected as investments, this is good to know. So the Buffett strategy, number one, is always buy great companies with great management. And buy them as if you could only have a license to buy 10 stocks in a lifetime, so that you make really, really thorough, well thought out decisions. Second of all, buy companies with economic moats. I'm going to talk about what an economic moat is. And finally, and most important thing, buy companies at a significant discount, 30% if possible, to their intrinsic value. I'm going to talk about how you calculate intrinsic value. And ladies and gentlemen, I have to admit up front that there's some heavy going in this presentation, but if you're going to understand how to invest properly, you've really got to understand the stuff. So as Warren said, be greedy when others are fearful and fearful when others are greedy. And it goes back to the point that I made at the beginning. I think we're at a point in time where there's a lot of greed out there. I just saw a company called Rivian is going to the market this week. It's an electric truck manufacturer. The estimated value of the stocks is going to be something over $50 billion. This is a company that's never actually sold a truck, but it's going to be worth $50 billion. So talk about the criteria. Criteria number one, how do you select great companies? Well, first of all, you should make sure that they're companies that you thoroughly understand, that you thoroughly understand their business. And there's a lot of great companies out there that are in fields like high technology or pharmaceuticals or whatever, that may be great companies, but unless you thoroughly understand their business, you should not be investing in them. The other thing is that under the radar companies are often a better buy than companies that are getting all of the headlines. Just as an example is Canadian Tire, which is, you know, a good old kind of stodgy Canadian company. But surprisingly, you know, can do very well in terms of its financials. Other companies that are well known but may not necessarily be a great stock buy because they're so expensive are companies like Costco, which I love Costco, Amazon, Netflix, Microsoft, Apple. All these are wonderful, wonderful companies. But because they're so well known by so many people and used by so many people, the prices of their stocks tend to get bid up and be very expensive. Criteria number two, economic moats. So what's an economic moat? Well, there can be a strong brand like Apple, Canadian Tire, Costco, or Amazon. It can be irreplaceable infrastructure, oil and gas pipelines, toll highways, container ports. These things are almost impossible to build new. They can be companies with a proprietary ecosystem like Microsoft and Apple, or superior technology such as Google and Amazon. Now remember, this is one criteria, that 1 out of 3 that you have to consider and look at. So let's do the first poll question, Aaron. So an economic moat is a strong brand, irreplaceable infrastructure, market-leading technology, or okay, I think just about everyone's voted, Aaron. So the majority chose all of the above, and you're absolutely right. So just to recap, it's all of these things or any of these things that give a company what's called an economic moat. The third criteria is a 30% discount to intrinsic value. So what is intrinsic value? Well, according to Warren Buffett, intrinsic value is simply the discounted value of the cash that can be taken out of a business during its remaining life. So when you buy a stock, you're essentially buying a piece of a business, and you should look at it exactly that way. If I'm investing in a business, I want to get income out of that business, cash out of that business, and I want to get it over a period of time. So we look at the intrinsic value being that flow of cash, but discounted back to the present value. Why do we do that? Well, let's talk about, first of all, what intrinsic value is, then we'll come to it. So intrinsic value is the discounted value or present value of a company's future earnings, the value of a company's brand, the value analysts place on a company, or the value of the hot tip from your broker. Please vote now. Okay, I think everyone's voted. So 96% of you said the discounted value, the present value of a company's future earnings, and that's correct. The value of a company's brand has an indirect impact on intrinsic value, but the real measure is simply this discounted cash flow. And I want to get to the point of emphasizing that that is what companies are worth. No more, no less than the discounted value of their future cash flow or earnings. And that's an important thing to remember when it comes to investing. So just to repeat, a company is worth the present value or discounted value of the company's future cash flow or earnings. So what's a discounted value? All right, a little bit tricky here, but basically here's the concept. $1 today is worth more than $1 10 years from now, what's called the time value of money. For example, if I owe you $100 and I say to you, okay, I'll give you that $100 today, or I'll give it to you in 10 years. You would say, I want it today. Why? Well, first of all, you can invest it. There's a return value, an interest value. And second of all, there's a risk. I may not be around in 10 years to pay. So there's the interest component and the risk component. So the discounted value of a future dollar is determined by what's called the discount rate. So what's the discount rate? And how do you calculate? Well, first of all, you need to know the earnings per share or cash flow of the company. You need to know the expected growth rate of the earnings per share or cash flow for 10 years. And you need to know this discount rate that we keep talking about. Now, I know what you're saying. You're saying, Michael, where am I going to get all this information? I'm going to show you where you can get it. It's actually not that hard. But you need to know these three things, and just these three things. So earnings per share or cash flow per share, expected growth rate, and this discount rate. So what's the discount rate? Well, the discount rate is a combination of the risk-free interest rate, which we'll call I, which is, say, the 10-year government bond rate, which today is about 1.5%, plus some risk factor, which we'll call R. All right? Because as I said, if you were getting money from me in 10 years, there's two aspects. There's how much interest you could earn on that money and the risk factor of whether or not I'll be around in 10 years or if I'll have the money in 10 years. So that's why growth companies that have high growth tend to have higher risk. So we use a higher discount rate. In this case, say 10%, 2% for I, the government interest rate, plus 8% for risk. So an example might be a company like Shopify, which has got very, very fast growth. But the question is, can it sustain that growth? Emerging markets also have higher risk. Why? You're just never quite sure what's going to go on in emerging markets. I mean, what's been going on in China lately with the Chinese government intervening in the regulation of a lot of their big successful companies like Alibaba. So there you might assign a discount rate of 10%. But if you come to companies like utilities, they, particularly utilities in North America, they have a much lower risk. So you might use 2% for the interest rate plus 3% for the risk rate. An example there might be TRP, which is TransCanada, or what used to be TransCanada Pipelines and is now called TC Energy. So you can see that we apply different risk factors to different types of companies in assessing what the present value or discounted value is. So how do you do this discounted value calculation? Well, luckily, you don't have to worry about understanding how to do it. It's built into Excel spreadsheets. There's a function called NPV, net present value, which calculates it all for you in an instant. It's available online. There are online calculators. So there's no need for you to actually do or understand the math. So we're not going to waste our time with that today. Basically understand, though, that as interest rates move higher, the discount rate goes up, right? Because the government bond rate, increases. So, for example, the 10-year bond rate, as I said, is about 1.5 today. 6 months ago, that was 0.75. So that rate has already gone up. So here's the effect. As the discount rate goes up, the discounted value goes down. So if interest rates rise sharply, stock prices may decline if there isn't growth in the earnings per share to offset it. I know this is a little hard to follow, but basically, if interest rates go up, the discount rate goes up and the discounted value of that stock goes down. And that's why in some cases, you'll see as interest rates go up, stock prices may decline, particularly if the earnings per share or cash flow per share growth doesn't keep up. So let's do another poll question here. So over the next 3 years, I think that interest rates will fall, rise a bit, rise a lot, or stay the same. Please vote now. Okay, I think everyone's voted. So most people think that interest rates are going to rise a bit. 27% think that it will rise a lot, 2% think it'll stay the same, and nobody thinks it will fall. So it's interesting. So if interest rates rise a bit, what's a bit, 1 or 2%, I guess, then the effect on discounted value probably is not going to be that great. But if interest rates rise a lot, then the effect on discounted value gets to be significant, and that can affect stock prices. So the other thing I wanted to mention, or have already mentioned, is that the higher the earnings per share growth rate, the higher the discounted value. And one of the issues here is that a lot of companies have unrealistic longer-term growth expectations, which has morphed into very high costs for their shares. And there's a question, can companies like Shopify, who have been growing their earnings per share by maybe 50% a year, how long can they keep that up? And it's not at all clear how long that can happen. So it makes it difficult to figure out what their future earnings, cash flow are going to be. And that's why you use a higher discount rate. The other way of looking at stocks to see if they're properly priced is something called the PEG ratio, which is the price to earnings ratio divided by the growth rate. So very simple ratio, but basically the price to earnings ratio is the price of the stock to its earnings. And then you divide that by growth. Some of the hot stocks like Tesla today are trading at a price to earnings ratio of over 300. You want to find a PEG ratio that's below about 2.5. So if you've got a stock that's trading at a price to earning of 300 and you want to get around 2.52, means that stock has to be growing its profits by about 150% per year for the next number of years. That's very tough to do. So the PEG gives you an indication of the value of stocks, much more useful than just price to earnings. And if you can find a stock with a PEG ratio, 1 to 1.5, that sometimes is a good indication of a well-priced stock. So it's one more tool that you can use to look at stock value. So where do you get all this information? Well, one of the best sources is Yahoo Finance. You can put in the symbol for any company. You'll get the earnings per share or cash flow per share. The reason some companies use cash flow per share is that particularly big infrastructure companies and a lot of mining companies, they've got so many non-cash write-offs like depreciation that it reduces their earnings per share substantially, but it's not their real value. Because if you, for example, own a pipeline and you're depreciating it, is that pipeline going down in value? Or if you've got real estate, are those buildings actually going down in value? And the answer is no, they're not. So it's a tax effect, which does not really give you an accurate view of the company. So you can get EPS growth, you can get analyst price targets for the company, and you can get analyst ratings for the company. And I'm going to show you what that looks like. So here is just a screenshot I took a while back for Amazon. At the time, it was trading at $3,200. It's actually up to $3,500 these days. And it'll show you this chart. This is just one day, but this chart is interactive. You can click on any of these and you'll get the chart for that period of time. You can see here, it shows you what the day's price range was, the 52-week, shows you the PE ratio here, which at that time was 56, gives you the earnings per share. If you click on these other tabs up here, like analysis, you get a whole bunch more information. And as I mentioned to you, this is all free on Yahoo Finance. And by the way, I'm in no way suggesting that one should be investing in Amazon stock. So you can get analyst ratings in a number of places, again on Yahoo Finance. I'll show you that in a minute. If you've got an online broker, they always have lots of analyst ratings in the various screens on whatever stock you're looking at. And Morningstar is also a very good source. So again, here's a screenshot from Yahoo Finance showing Analyst Ratings. You can see over here, this is their earnings per share trend, and you can see the amounts that the analysts on average are predicting for the current year, the next year. This graph over here shows you how the different analysts are rating the company. So when I looked at that, there were 47 analysts rating it. 15 were rating it as a strong buy, 26 as a buy, hold and sell. And the average rating number was 1.7. So this is a way of getting a view of what the average of analysts are thinking about a stock. One of the things to mention here is that the opinion of any single analyst is not necessarily all that helpful. I did a little checking recently to see how accurate most of these financial analysts are, and it's about 60%. But if you're looking at all of them, 47 of them, and you see the average, you can feel a little more comfortable. So I ran this through just to show you how this discounted value works. And again, bear with me here. And again, I did this a few weeks ago. Amazon is a bit higher now, but this is a little discounted value analyzer that I built in Excel. And it shows you the current price at the time. I used a discount rate of 5% because I thought, Amazon, pretty solid company, not too concerned about their ups and downs. I put in their current earnings per share, which I got from Yahoo Finance. I put in these growth figures, which I also got from Yahoo Finance. You got to take these with a grain of salt. 37% growth, and that's pushing the envelope, perhaps. Anyway, when you put it through the discounted value calculator, it came up with a discounted value of just over $3,000, which is less than what it was selling at. But we don't want to buy it at discounted value, which, by the way, is also sometimes called fair value. We want to buy it at 70% of discounted value, 30% off. That's down around $2,100. So even though the PEG ratio is 1.74, which is attractive, the discounted value is not. So in this case, if you were a believer of this approach, you'd say, I think I'll wait and see if I can buy this stock when it goes on sale. The other thing I wanted to mention very quickly is, before we close, the four most dangerous words in investing is this time is different. We're going through some amazing things right now with Bitcoin, the digital currencies. I read this morning there are 10,000 digital currencies being offered out there. And I think one of the things that we, particularly as seniors, have to understand is the difference between speculating and investing. Investing is when you do your homework and you determine the value of a company and you invest in it as part of the business for the long term. Speculating is when you buy whatever is hot. So to close, the stock market's a device for transferring money from the impatient to the patient, according to Warren Buffett. So you want to wait until the price is right, meet your target, don't jump at things. And just to reiterate the stock buying strategy, buy great companies, great management that you thoroughly understand, get a wide economic moat. By the way, Morningstar also rates and gives you an indication of what they believe companies' economic moats are. You want to buy at 30% below discounted value. There ain't many to buy right now, I can assure you. And you want to have the idea that you're going to hold that company forever. If you're interested and want to get a copy of my discounted value analyzer that you can fill in yourself, you can send me an email, securewealth2021@gmail.com. Just put subject line analyzer. Excel is required to be able to use this. So securewealth2021@gmail.com. So one final poll question before we close. I felt that this webinar was understandable and implementable, difficult to follow or implement, or I'll stick to ETFs and mutual funds. Please vote now. Okay, I think everyone's voted. Well, so for those of you who found it understandable and implementable, congratulations to you, because this was not an easy webinar. For those who found it difficult to follow, I understand that completely. It is difficult. And it tells you that you don't want to be buying individual stocks. And for those of you who say, I'll stick to ETFs and mutual funds, congratulations. I think you're making the wise choice. So we'll post a recording of this on my YouTube channel. Go to youtube.com and in the search, search for Secure Wealth and you should find it. And with that, I'll say thank you very much. I hope soon to be back where I can wear this hat. And I hope you all have a good winter and get some warmth also. So with that, I will turn it back over to Alain for some questions.
All right. Thank you very much, Michael.